Today we are talking about waterfalls. So this has been a topic that I've wanted to discuss for a while now. I get questions about this here and there, and it's really a bit of an advanced topic. So I don't always have the time to explain it thoroughly when I'm on the phone or over an email. So I've been looking forward to having this longer forum to really dig in. And the other thing too is at the end of the day, when we're talking about the actual calculations and the construction of the waterfall, it's it's kind of boring and not everyone really needs to know how it works. At the end of the day, the majority of us don't really need to know how these things work. We just need to understand that they do work and that they kind of create the partnership split or the performance compensation that we're looking to achieve. So without further ado, I'm going to go ahead and share my screen. And this here is our underwriting model, and it's actually an example deal. So this is a deal, Broadstone Briar Forest, that we closed, I think sometime last month. So this was a really great deal, and I'll be showing you our waterfall, and we'll be kind of deconstructing it and putting it back together. And of course, as always, if you have questions, I like to make this interactive, so please put them in the chat. And also, if it makes sense, feel free to raise your hand or unmute yourself essentially and ask the question live. Either one works. It's a lot of fun when it's interactive, so I'm looking forward to it. So to set the stage, just to give you a sense of what we're working with, right? The focus today is not on deals, not on pro formas. It's about the waterfall and the structure of it itself. But just so that you understand what we're working with, this example deal is a roughly $49 million purchase, and we acquired the property with about $43 million of debt, and we projected a 3-year hold. And more pertinent to our conversation, here is the waterfall tab where the actual partnership structure is outlined. So first, this is pretty much how we structure all of our deals. First, there's an 8% preferred return. I'm sure many of us on this call are familiar with what a preferred return is. I just sent out a newsletter with the article talking about preferred returns, what they are and what they are not. But I can certainly cover that on here as well. After the pref of 8%, there is a promote of 30%. And the way to read this table is up to 8%, there is no promote. And what does that mean? That means the sponsor gets no performance compensation up to an 8% return for the investors. That's why there's a 0 there. Also, as a side note, similarly, as I explained in my newsletter article, our preferred return is a cumulative and compounded return hurdle plus 100% return of capital. So essentially, it's an 8% IRR, which is the preferred return. So that means the sponsor receives no performance compensation or carried interest or promote prior to the investors achieving an 8% IRR. Above and beyond the 8% IRR, and the way to read this is up to a 15% IRR, there's a 30% promote. So that means after the 8% has been met, anything above that, there's a 70-30 split, 30% to the sponsor, 70% to investors of the remaining proceeds or distributions, cash flow, what have you. And then finally, this is pretty straightforward, but above and beyond a 15% IRR, the remaining distributions are split 50-50. So let's go through that. And I'm going to actually set this to 0 to make this a bit easier to read. So I'm sure many of us are familiar with waterfalls and preferred returns and have seen structures like this, have invested into structures like this. But today we're actually talking about how it's calculated. And we're going to walk through here what you see below, which are the actual calculations, how they work, and kind of the math behind this. So we can ignore kind of the unlevered cash flow and the levered cash flow. What we're really starting with is this line here: net cash flow for distribution. And what that is first off, we have the levered cash flow, and then we just layer in the fees. And then we have kind of the cash flows that are ready to be split at the waterfall level. So just to rewind a bit, at a project level, right? If there were no sponsor fees taken, no promote or anything, here's what the cash flow would look like. And that would be a 24.7% IRR. But of course, right, these deals require fees to be run with the corporate overhead, et cetera. So factoring in the fees, you get this net cash flow, which is a 20.8% IRR. But that's pre-waterfall or pre-promote, right? Because of course, as the deal performs, the sponsor gets a performance compensation, and then what is left over is finally the LP IRR or the true net IRR, which is what investors take home. So starting with this line, this is actually the cash flows that are going to flow through our waterfall. And I'll explain it line by line. And I do apologize in advance if this gets boring. Maybe that's the reason why I haven't done this this topic yet after all this time, but people have been asking for it, so I'm going to give it. So again, focusing here, what's the first number in this distribution schedule? We have the outflow, right? The initial investment of 13.5 million in this case. So the way I do it is I basically have a year zero where I start the end of period capital account as 13.5. So what is the capital account? The capital account is essentially what the investors are getting credit for having invested into the project, right? As soon as you put money into the project, that's your capital account. And now, based on the waterfall or based on the structure where there's a preferred return, now you are owed a preferred return based on your capital account. And what am I trying to say here? The pref clock starts, essentially as you put the money in. I mean, depending on different deals have different rules as far as, the pref clock, meaning you're actually accruing your preferred return at a certain time. It could be when you fund, it could be when the deal closes. Funds and deals are all different. But so we start with end of period capital account, right? There's nothing in the deal. Then at the end of year zero, we start, but really it starts with year one. So at the beginning of year one, we have a $13.5 million capital account because investors invested $13.5 million. Now, what are they owed on that $13.5 million? Well, going back to our promote structure, right? Of course, they're owed that 8% preferred return. That doesn't mean they are owed it necessarily in cash flow, and that doesn't mean that the deal is going to pay it in cash flow, right? Preferred return means nothing or doesn't correlate to cash flow. But that 8% is going to accrue and compound. So the second line that we have here is tier one hurdle. And as you can see by the formula, it's just multiplying the beginning of period capital account by the pref. So 8% on 13.5 million is roughly $1,080,000. So that is the preferred return that is accruing on the capital account. Now, based on our projections on this deal, what is actually distributed or projected to be distributed in year one is $680,000. Now, if I just go back to our summary page, that's a 5% cash on cash, right? So obviously we see that the difference between the preferred return of 8% and what is actually distributed, which is 5%, is 3%. There's a 3% shortfall. And you can clearly see it, right? $1,080,000 versus $680,000. Now, that $400,000 difference, what happens to that difference? How do we account for it? Well, it actually gets tacked on to the capital account. So in year one, we invested $13.5 million, but at the end of year one, we effectively have invested $13.9 million. Now, please let me know in the chat or however you want to if that doesn't make sense. But because this is kind of the fundamental way that the waterfall calculates the compounding nature of the preferred return. And it'll make sense in year two very shortly as well. So just to recap, right, we started year one, we invested $13.5 million into the project. As investors, we're owed an 8% preferred return. I'll also make this bigger. This will be a bit easier for everybody. So we started off with 13.5 million. That's what we invested. We're owed an 8% preferred return for year one. So that's $1,080,000. However, what was distributed is 680. So that $400,000 shortfall gets tacked onto the capital account, which the end of period capital account for year one now becomes the beginning of period capital account in year two, right? You can see it's simple, 13.9, now 13.9 here. I'll take a pause real quick. Garrett is asking, why do you compound? Is that what your investors are requiring? Okay, great. So, certainly our investors aren't requiring it, but it is industry standard in the more institutional space. So, we like to think of ourselves as kind of more of an institutional sponsor that caters to both high net worth investors as well as the larger family offices and institutional investors. So because of our diversity of investors, we work with small investors from $50,000 checks to $15 million checks. It runs the range of sophistication, right? So some of our investors invest in us as their job, as their fund, as their profession, and then we have people who just do it on the side and it's very passive and they're not experts. But what we like to do is, we don't like to dumb things down for our investors. The same way we treat our really sophisticated professional investors on the fund side is the same way that we like to treat our individual investors as well. So we provide compounding preferred returns and all the other bells and whistles that institutional investors come to expect in a deal, and we just provide it across the board. So that's kind of who we are a little bit and kind of why we do this compounding. But yeah, it's a good question. So to get back into the actual math of the compounding, we take the end of period capital account in year one, we bring it over to year two. And now here's where it gets really interesting is, again, in year two, we're owed a 8% preferred return, right? But now that 8% is calculated not on 13.5, not based on our original investment, but on the period capital account. So based on years two beginning period capital account of 13.9, as investors, we are now owed an 8% preferred return on that, which is 1,112,000 versus the 1,080,000, right? And that's where the compounding comes into play. Essentially, what happened was the $400,000 shortfall in year one that accrued and was added to the capital account earned 8% interest, right? So our shortfall earned interest on itself, which is the compounding nature, right? And the reason for compounding, right, is it penalizes the sponsor for not providing distributions in the current period, right? $1 today is worth more than $1 tomorrow. So it's not fair for our investors to say, oh yeah, we're going to give you an 8% preferred return, but how about we just pay you 24% on your money 3 years from now, right? All of us in this room would prefer to get 8% year one, 8% year two, 8% year three, then have to wait 3 years to get 24%. It's the time value of money. So compounding protects investors against that. So you can see in the projections here, we are at projecting to distribute 822,000 in year two. So again, there's a shortfall. So what happens? Well, the difference between the preferred return that accumulated in year two and what was paid out gets added to the capital account. So now our capital account has grown to all the way to 14.2 million. And again, same thing happens. We carry over the end of period capital account. It becomes the beginning of period capital account in year three. And again, we add an 8% preferred return on the capital account. So our preferred return of 8% on a dollar basis is growing each and every year, right? Started at $1,080,000, now to $1,012,000 or $1,112,000 to $1,135,000. So that's the compounding nature. And here's, finally, we're getting to the conclusion of this. And it's good that this is a 3-year projected hold, not a 5-year, because we've been doing this for longer. But in year three, we're finally projecting the sale of the property and the unwinding of the deal. So you can see what is needed in order to meet the preferred return in year three. Well, it's $1,136,000. However, what is distributed in year 3 is $15.3 million roughly, right? 15.3. So obviously, when it comes to the sale distribution of this full big $15 million, that's enough money, obviously, to satisfy the preferred return and then some. So this tier 1 section is this tier 1 is back up here, right? Tier 1, it's the preferred return. All we're trying to distribute in tier 1 is the preferred return. So that's exactly what we do. And here we have the IRR check. So basically you can see this was distributed in year 1, this was distributed in year 2, and then this is distributed in year 3, and that is an 8% IRR. So by giving investors that 15.3 million in year 3, we have now satisfied tier 1. We have provided a 8% cumulative and compounded return, and we've returned all the original capital back. And you can see that that is the case by simply running an IRR calculation on that. So, however, there's more actually to distribute, right? If we look back at the net cash flow for distribution, there's actually almost 22 million to distribute. So we only distributed 15.3 in this period. And the difference between the 22 and the 15.3 is roughly 6.5 million. And that's the cash that's remaining in the waterfall still that is now to be distributed in tier 2. What is tier 2? Tier 2 is, again, interpreting this table, it's a 30% promote up to a 15% IRR. So now in tier 2, every dollar is split at 70-30. That's how tier 2 works. I'm going to take a pause really quick before we dive into the tier 2 table, and I'm going to answer some questions. Johnson is asking about a copy of the recording. Yes, absolutely. We always send a copy of the recording out. If you registered for this, you'll get the email. Will a copy of this model be made available? Let me think. I have the blank the blank model is available, but I'll see about including this particular model in the follow-up email as well. All right, another question. William is asking, if the hurdle isn't met, it carries until sale disposition and it is paid out at sale, correct? Yes, that's exactly right. So as you saw, going back to tier 1, we never met the preferred return on a cash flow basis, right? It took the year 3 sale to finally catch up and actually meet that 8% IRR. And also, just as a note, right, even if you are paying 8% distributions every year, you're still not satisfying the tier 1 hurdle because it's an 8% IRR. You have to return all capital. So it's not enough to just pay $1 million in cash flow every year. You have to return the original 13.5 million. So it pretty much, satisfying this tier 1 hurdle pretty much always requires a sale, right? You'd have to hit a refi, total home run refi in order to be able to actually hit this tier 1 hurdle without a sale, right? And what that would be is you do it. Let's say you were cash flowing at 8% or above, and then you did a refi, and that refi was 100% cash out. You're able to return all the original capital back to investors. That would actually meet this tier 1 hurdle. And then that's pretty neat situation because every dollar of cash flow that the deal continues to produce post refi would be split 70-30. So this is actually another interesting topic that I get a lot of questions about, which I will be doing an article about, maybe some videos about, and that's about how refis are treated. I mean, there's a lot of variation in how deals treat refinances. And, of course, no one structure is right, but I'll be kind of sharing my opinion on the different structures, and of course sharing our structure, which is kind of which follows this exact thing, right? It's again, when on a refi, there's no different than a sale. It just still follows this promote structure. So the question I get from investors a lot is, well, upon a refi, if you cash us out, are we out of the deal? Is our ownership reduced? And the answer is no. Investors' ownership in the deal remains the same upon a refi, and they're still entitled to their returns based on this promote structure. So that'll be a topic for another day, but that I do get a lot of questions about. Yeah. So Garrett and Gregory, you guys are asking about the blank model. If you guys want the blank model, go ahead and go to our website. And our free model download is always available, and I'm always updating the model and then making sure the updated model is in that download link. So go ahead on our website and you can download the blank model there. A couple more questions here. At what point is the sponsor's equity returned? Is it pari passu with the LP or only after the first hurdle is distributed? All right, awesome question. The answer to that is obviously it depends on the structure, right? You can structure a deal however you like, but for the most typical deal structure, which is what we have in front of us and our structure that we're sharing today, the sponsor's equity is pari passu. And what pari passu means literally in Latin is shoulder to shoulder. So basically, there is no priority of distribution between the LP equity and the sponsor equity. So I'm the sponsor, right? If I put $100,000 in and you put $100,000 in, both of our capital accounts are going to accrue and get paid the same at the same time. All right. So if you get a $5,000 distribution, I'm getting a $5,000 distribution. It happens at the same time. I'm owed an 8% preferred return. You're owed an 8% preferred return. There's no senior subordinate relationship. And that's what Benjamin is alluding to, because there are structures which can, which look all sorts of different ways. For example, like a participating preferred equity piece where the sponsor's equity is subordinate first to, for example, the LP or the preferred equities pref, and then there's some splits and whatnot. But for this discussion, it's pari passu. Joe is asking, when sponsors advertise a percent pref, is that always assumed to be an IRR metric? So no, unfortunately, most deals do not. Most deals in the syndication space do not have an IRR-based preferred return. However, if you look beyond the syndication space and you look at, Blackstone, and well, not even, you don't have to go quite that far, but if you just look at really the more savvy, more sophisticated, more institutional deals that are happening all the way up the chain to Blackstone, they're always going to be essentially an IRR-based preferred return. And that's what we're talking about today. And if we do have time, which it looks like we will, I can show you what a cash flow promote based preferred return, or American waterfall versus European waterfall. I can show you what that looks like in the spreadsheet if there's interest. So let's get into the tier two. So as we said, right, there's 22 million roughly in sale proceeds. And in order to satisfy the 8% cumulative and compounding preferred return, we paid out in tier one effectively 15.3, leaving us 6.5 million in cash flow that now can be essentially split. Long story short, split at 70-30 in the tier two, but it's not quite that simple. So let's actually run through it line by line in tier two. So again, in tier two, we have the same exact situation. We have the end of period capital account in year zero being 13.5. That starts us off in year one, 13.5 million. Again, we distributed 680,000 in tier one. That was the 5% cash on cash in year one. Now, the way that tier two differs is we have a tier two hurdle. And let's go up here and see what the tier two hurdle is. Well, it's 15%. So we look here and we see that 15% on 13.5 million is 2 million, right? Now, of course, we weren't hitting the 8% preferred return out on a cash flow basis. So obviously we're not going to hit 15% on a cash flow basis, which is fine. We're not supposed to, but what it's going to do is it's going to add that $2 million less what is distributed to our capital account. So now our capital account on a tier two basis is 14.8 million. So that becomes our beginning of period capital account in year two. And again, we had prior distributions of 820,000. We are now calculating a 15% return based on this larger capital account of 14.8. So what this is doing is it's effectively calculating the 15% IRR that investors are owed prior to moving on to this next tier, right? This is, somebody mentioned somebody mentioned Benjamin saying an IRR look back. I'm saying essentially here we are looking back upon sale and looking to achieve a 15% IRR. So same thing we do in year 2. We take the hurdle rate less what is distributed, and we tack that onto the end of period capital account. So now the capital account has ballooned to over 16 million. And in order to satisfy the 8% pref, we paid out 15.3 million, right? And in order to hit the 15% IRR, there's a 2.4 million, which is the 15% on 16. I know there's a lot of numbers now. And then in order to meet the 15% IRR, we actually have to distribute another 3.3 million on top of the 15.3 million for a total of 18.7 million to hit the 15% IRR. And if you don't believe me, right, it's right here, the IRR check, and this right here gets you your 15% IRR. It's 13.5 going out the door as your original investment. You get 680,000 in year 1, 822,000 in year 2, and then 18.7 in year 3. But remember, we actually have a total of 22 million to distribute. So what is left? You can see also what I need to actually show. And because we're doing it with the sponsor investing no dollars, it kind of makes the formula funky post sale, but you can just ignore that. The point here is we distributed 3.36 in tier 2. And remember, every dollar in tier 2 is split at 70-30. So that means that of what was distributed in tier 2, this number here is 70% of what's distributed. And then the sponsor gets 30%. So that's 1.4 million now to the sponsor. So the sponsor earned 30% of every dollar in tier 2, like we said. After tier 2, there's still 1.7 million remaining in cash flow available to distribute. And that gets carried over to tier 3. Now, tier 3 is super simple in this case, right? It's just anything over that 15 is split 50-50. So you can see if we have 1.6 and change to distribute in tier 3 rather, it's just 50-50. And you can see that 843, right? It's a 50-50 split of whatever is remaining above and beyond that 15% IRR. And there you have it. That is walking through the waterfall. And just to wrap it all up, the LP IRR is a combination of what is distributed in tier 2, which is 3.36 million, and what is distributed, well, I'm sorry, it should be, well, we'll start from the top. It's what is distributed in tier 1, which is here, plus what is distributed in tier 2, which is this, plus what is distributed in tier 3. And when you sum it all up, you get this stream of cash flows, which is a 16.6% projected IRR. So that is the passive investors or the LPs projected return after all fees and promote are paid. And that, walking you through it, is exactly how we calculated it on a compounding basis. And that is really the waterfall. So let's see if there are any questions before we move on. So question is, in theory, there are myriad ways to structure the following. 1, a return on capital. 2, a return of capital. And 3, the timeline over which 1 and 2 occur. Is that correct? So yes, obviously there's lots of different ways. At the end of the day, even though there are so many ways to structure a deal, there's really only so many kind of typical ways to do it. And this being the most kind of traditional way. And the way that it works is step 1, as you kind of mentioned, is the return on capital, right? Step 1 is you need to get your 8% pref. Step 2, after your 8% pref is met, right? This is going back to the tier 1 talk. After the 8% is met, Now we need to return all the capital back. So step one, return on, step two, return of, and then thereafter we have the promote. The timeline over which 1 and 2 occur, I'm not quite sure if I understand your point about that. If you want to add to the chat or unmute yourself, we can cover that. But I've heard people talk about like, oh, be careful if the sponsor has a return of capital in their structure because they're trying to pay you off and get you out of the deal. That's really, I mean, maybe it's true, but it's essentially nonsensical. You can't really have a preferred return if the step one in the distribution schedule is return of capital, because if you return of capital prior to returning the pref or prior to accruing the pref, that means you're constantly reducing what that pref is because you're reducing the capital account. It doesn't make any sense. But the kernel of truth in that, or the misconception, comes from the fact that in this structure, in this calculation of the preferred return, if the situation were flipped and the tier one distributions were in excess of the hurdle, then the compounding nature of this preferred return would actually work in reverse. Instead of the capital account getting larger with every year, it would get smaller. And that means instead of the preferred return on a dollar basis growing every year, it would get smaller, right? And I can actually just show you an example. Let's just imagine that, you could run this deal with no payroll, no insurance, and, you didn't have to pay property taxes. Now, your cash flows are great and they're going to be in excess of the preferred return. So here you can see, if we're distributing 2 million in year one and the preferred return is only 1 million based on the 8% pref, the end of period capital account is going to shrink by $1 million, right? You can see it started at 13.3, goes down to 12.3. So now the 8% pref in year two is only 984,000 instead of 1,066,000. So, there is some truth to the fact that the compounding nature of the pref can reduce your capital account, but at the end of the day, it's not nefarious or harmful to investors. It's just accounting for the compounding nature of the preferred return. So I can kind of show that more, but I thought that was actually a pretty good thing to not forget, which is the fact that compounding nature, right, works either to grow the capital account or to shrink the capital account, depending on what is actually distributed. So I'm just going to undo my wishful thinking. And let's see, I got a little distracted by that. Okay, so I think that answered that question. Let's see here. So William's asking about the model being scaling to 10 years. And yes, that is correct. This model can go out to 10 years. What happened to the 6.5 million cash flow remaining in tier one? Okay, awesome. So this 6.5 million that's remaining trickled down to the subsequent tiers, right? So if we look at the summation of what was distributed, and I'm saying distributed in air quotes now, because at the end of the day, when we sell a property and we have all these, we're running through the waterfall calculations, we don't make separate distributions for the tier one or tier two, right? Investors just get one check and it's, $200,000, and it accounts for their initial investment and for everything that they're owed for as far as the sale is concerned. So when I say distributions, I'm not meaning actual different checks being sent out, but just what is, quote, phantom distributed in each period. But nonetheless, if I sum everything that is distributed in tier two and tier three, it's going to equal 6.5 million. So I'll answer the question in more depth, but in short, that's where the 6.5 million went. It went here, and it went here, it went here, and it went here. And that totals 6492925, right? Which is the same as this. And if you want to make sure of that, you can see just the Excel calculator there, sum. So it equals this, right? But to actually explain it more, right? After tier one was satisfied, we had 6.5 million remaining. 70-30 of that, up to a 15% IRR, was split in tier two. And then above the 15% IRR, it was 50-50. And that's where the 6.5 million went. Hopefully that makes sense. Okay, Gregory's asking about the sponsor not contributing anything up front and then earning a promote of 2.3 million. Is it common for sponsors not to contribute anything to the deal? I would say no. You always want to see your sponsor put something in the deal. The reason why I set it to 0 was for informational purposes only, just to make more sense of the deal, right? In a typical situation, right, you might have the sponsor putting in 5-10% of the equity. But if I would have walked you through this, it maybe would have made the waterfall a bit more confusing, because we'd have to go through the LP capital account, the sponsor capital account, and then also what it would do is it would conflate the sponsor distributions owed to them based on their capital, as well as owed to them based on their promote. So at the end of the day, right, whether the sponsor puts in 10% or 0% of the capital, based on this structure and projections, they are owed this promote. So it's not like, well, they make less or more or whatever. This is their promote. This is what they're owed. And if they put 10% of the equity in the deal, as what is fairly common, that 10% sponsored equity contribution of 1.35 million is going to be treated just as the LP capital is treated, right? It's going to follow this same structure. And you can see that here, right? The sponsor gets their 8% pref in tier 1, and then they get paid the the sponsor effectively pays a promote, which then comes back to them in tier 2. And you can see it kind of breaks down because the capital account turns negative, because the sponsor is getting more money than what they contributed because of the promote, right? And the promote is essentially that's what a promote is. It's to compensate a sponsor for performing, and it's in excess of their capital, or really irrespective of their capital contribution. So anyway, that is why I set it to 0. But no, it is not common for a sponsor to not put anything in the deal. It's something that's very important. I had a video go out recently about skin in the game and how it's important that sponsors co-invest and all that jazz. Patrick's asking about what our view is on a monthly versus annual IRR calculation. So there's a couple ways to interpret that question. So first off, right, IRR is an annual calculation. That's just what IRR is. And when we're actually running the waterfall, and maybe if we have time, I'll pull up actually our XIRR waterfall module, which is what we actually use to calculate the waterfall upon sale, right? We'll look at all of our distributions through the life of the deal, and we'll calculate, and the industry standard way that everyone in the institutional world calculates XIRR, I'm sorry, the way they calculate IRR, I spilled the beans, is through XIRR. And XIRR is a Microsoft Excel calculation. It's right here. If I go like this and I start typing in the formula XIRR, you can see it's just an Excel function. And what it allows you to do is plug in a stream of cash flows and attach dates to those stream of cash flows. So you get an exactly precise IRR calculation through XIRR. So at the end of the day, it's a annual compounding. IRR is an annual compounding metric. But when we actually calculate upon a sale, it's calculated to the day in precision based on XIRR. And then another way to interpret your question is, well, how are you actually getting these numbers here on this page that flow into this waterfall? And the answer to that is yes, of course. In our pro forma, we have monthly projections. So the projections are precise to the month, and that's what flows into our annual waterfall, which then is how we derive the projected returns net of fees, net of promote. Okay, so Jack is asking about future cap rate projections and the trend in expansion. due to higher interest rates. I believe this is important as your IRR is highly dependent on projected cap rate at sale. Yes, that is absolutely right. Very hot topic. I'm going to do my best to refrain from diving into that rabbit hole because we are going to have our quarterly deal flow analysis webinar coming up, where Charles, our director of acquisitions, and I go in super depth on exactly this topic. We cover all the deals we underwrote for the previous quarter, the trends we're seeing, and I have a hunch that the data will show that we are seeing some expansion. If any of you have followed us in those deal flow analysis webinars, you've seen that the cap rate that we've observed as an average across our pipeline has continuously gone down. So cap rates have compressed, and I think this webinar that we're going to host upcoming, which is going to be analyzing Q2 data, is going to show the first quarter of expansion. So I'll leave it at that. I won't pontificate on the future, but definitely join us for that webinar. That's where we go really deep on that stuff. Mark is asking about, based on my comment about the pari passu, is there a way in your underwriting model to not underwrite a pref or waterfall, but instead take your 30% split off of all cash flows, refi, and sale? Yes, of course. There's multiple ways to do it. One way to do it would simply be to have a 0% hurdle rate in tier 1, right? And then you would just go 30% right off the bat, and you could just go like this. And now that means regardless of what's happening, you're taking 30% of everything. I don't recommend investing in a structure of that nature, but you absolutely can, and you can structure it in the model as well. I'll leave that at that unless someone wants me to go further into that topic. Okay, Ed is asking about why the capital count increases in tier 2 in year 1 and 2. Shouldn't it just flatline until sale in year 3? So the reason why the capital count increases is to account for the compounding nature of the preferred return, as well as the secondary hurdle of 15%, right? So both of these hurdles, 8% and 15%, are IRR based. And of course, IRR is a compounding calculation. So taking tier 2, for example, right? We can't hold the capital account static because then we wouldn't be compounding the return properly, right? So the way that the compounding works, just to recap again, is in tier 2, we're owed a 15% return. And so we calculate 15% on 13.5, that's 2 million. Less of what's distributed, that gets tacked on to the capital account. So that way the 15% grows, right? You can see it going from 2 million to 2.2. And so we finally satisfy that upon sale in order to meet the compounding 15% return, right? And also, just as an example to make, hopefully make some more sense, if I do a sum of, like these returns, for example, and I divide it by what we invest up front, and let me, hold on, I didn't do this quite right. If I do that, and I take the sum of that, and then I divide it by the number of years, I get a 16.5% simple annualized return, right? So that's the difference. These numbers aren't just simply 15% plus 15% plus 15%. That's not what an IRR is, right? These numbers are actually, if you simplified it into linear terms or simple average, it would be 16.5% plus 16.5% plus 16.5%. That is what the annualized return is for this stream of cash flows. And when you run an IRR, because of the time value of money, it's only a 15% IRR versus the 16.5% return, right? And so at the end of the day, IRR is a bit more complicated, and there's more things that go into it, which is why often you see a lot of people kind of in the syndication space or the less sophisticated space talk about annualized return. And that's why we have it here. We have IRR here, and then we have annualized return here. However, it's pretty funny. I have had kind of institutional type investors looking over our model, and they'll go, what the heck is this? What are you talking about? This doesn't make any sense. They're so confused because they're just in IRR world, right? But then on the flip side, you have passive investors and they don't know what IRR is. They get confused, not to mention the fact that IRR is lower. So, a lot of people like this number as well. So that is kind of the rationale behind the compounding there. All right, a few more questions here. A lot of more questions. This is the most questions we've ever gotten, actually. Okay, in your modified example, why is the excess over 8% pref treated as a tier 1 capital reduction versus the excess dropping to a tier 2 income distribution? Okay, excellent. So the reason for that is because we can't move to tier 2 until we have satisfied tier 1. And the way to satisfy tier 1 is to pay back the original investment. So if I just quickly get back to my dream scenario of not paying any insurance, payroll, or taxes or anything, you can see in tier 1, we can't move on to tier 2 until we have reduced the capital account to 0 and met the 8% pref. And in spite of these fabulous cash flows, we actually don't do that until the sale. Now, however, let's see here, if I extend the hold period to 10 years, you can see actually by year 9, we are able to satisfy tier 1 based on cash flow alone. We are able to pay both an 8% compounded return and provide investors their original investment back just off cash flow. So you can see we reduce the capital account. It gets reduced from 13.3 to 12.3, 11, 9, 7, 6, 5, 3, 1. And then finally, we're able to pay it all off in year 9. So that would mean in year 10, right, everything, cash flow, refi, sale, anything is split 70-30. And that's what you can actually see prior to year 10, we already have money, $1 million, that is able to be moved on to tier 2. So that's why we can't just move on to tier 2. We have to satisfy tier 1. Okay, Sabrina's asking about a clawback scenario. I don't have any clawback scenarios, nor do I have that capability modeled into the spreadsheet. I'm not exactly sure what you mean. I mean, I conceptually know what you mean by a clawback, but a clawback is not very common in the private equity space, in real estate syndications. And the reason for why it's not common is because of this preferred return, right? This preferred return effectively operates as a clawback, right? If you take the inverse, where you don't have a cumulative compounded preferred return subject to return of capital, which again is just basically an 8% IRR. If you don't have that and you just have a simple pref of, let's say, 8% cash flow, that means the sponsor can earn a promote on cash flows in excess of 8%. So let's say in year 1, 10% is distributed. Well, the sponsor is going to earn a promote in year 1. But let's say something bad happens with the property or the market, and in year 2, there's only 5% distributions, right? The sponsor is not going to give back the promote they took in year 1, and they're not going to earn a promote in year 2 because the year 2 cash flow is 5% and the pref is 8%. But you can see that's the problem. The problem is the sponsor was paid a performance comp in year 1, and then the property suffered and performed below the preferred return, but the sponsor wasn't penalized. And that's the reason why clawbacks aren't common, because the pref acts essentially as a clawback. But if you have a further question about that or example, happy to go through it. Joe is asking, let's say there's a refi in year 2, is capital returned, or is the pref made whole first and then capital return if still excess? Yes. So Joe nailed it. There's some beautiful simplicity about this structure right here, and it being an IRR based hurdle, is it doesn't matter where the dollars come from, whether they come from cash flow, refi, or sale, they're all treated the same. So when we have a refi in year 2, for example, the cash coming out of the refi first has to go towards satisfying, again, the same thing, tier 1. And tier 1 can only be satisfied by first getting the pref paid and then returning capital. So it's the same thing in a refi. You have to hit the pref first, and then if there's excess, we can return capital. Christine is asking, why don't you recommend investing in a straight split structure? The answer is pretty simple, is there's no reason to, right? There's so many good sponsors out there with good deals that offer a structure like this, which is so much more favorable than a 70-30 split. And I have an article about this a long time ago that actually really that compared models side by side, and the returns aren't that different depending on the structure, right? So if I change that, well, we can actually just look at this deal as an example really quick. Okay, so I think we're back to normal. 16.6 projected IRR, right? Now, if we change this, actually an example is going to be really helpful here. So if we change this to just a 30% straight split, right? So straight 70-30. And then what I also see in deal structures of this nature are they don't charge an asset management fee, right? They say, hey, no asset management fee, but everything's split 70-30. You can see the return is lower, not by a ton. It's 16.6 versus 15.9. So that's not like, oh my gosh, a deal killer. But the cash flow is lower. And so I forget what the cash flow was originally. So I apologize for that. So the cash flow in the preferred return structure is 6.3%. And long story short, or let me also just, when you have this IRR hurdle structure, something that we kind of glossed over, but it's a really big deal, is that all cash flow goes to investors. Just logically speaking, it has to, right? We can't go to tier 2, which is where the sponsor promote is, until investors get an 8% preferred return and their money back. So how could you do that from cash flow, right? We saw it in a scenario where you're cash flowing crazy, you still only hit there in year 9, right? So pretty much in all circumstances, you have to, all cash flow goes to investors, which is a fabulous thing, right? To be able to tell investors, you get all cash flow, you get all the cash flow. So in the 70-30 structure, that's obviously not true, right? Every dollar is split 70-30. So that's bad from a cash flow perspective, right? And you can see somehow the cash flow is higher. There must be some mistake here. I need to figure that out. But logically speaking, right, the cash flow has to be lower because we're taking 30 cents of every dollar as the sponsor. The thing that's even worse about this structure, though, oh, I know what's wrong. It's because this is still, okay, so the advice I gave someone earlier about structuring it, this is wrong because this is still a 0% IRR, and a 0% IRR still means you get the original investment back. So in a true scenario where there is no IRR hurdle, even if it's a 0% IRR, that will show you where the split happens right away. And so you can see we're taking 30% of every dollar. And so that's resulting in an average cash on cash of 4.9 versus 6.3. And so obviously the returns are worse. And see, now that I've got things right, I apologize. Now we can actually compare, right? It was a 16.6% projected return with 6.3% average cash on cash. And now with the 70-30 straight split, no asset management fee, it's 15.6. So it's 100 basis points lower projected return and a 4.9% cash on cash, which is about 1.5% less. In a world where cash flow is so tight, I wouldn't want to shove this down investors' throats and say, well, you get to suffer with even less cash flow. But that's not even the worst part of it. The worst part of it is investors have no downside protection. For every dollar of return, for every dollar of decreased return, investors feel that pain. In a preferred return structure, investors are supported by that 8% pref, right? If the deal underperforms, right? Let's say the deal was projecting, 10%, and then it turned out to only get 8%. Investors are going to get the lion's share of that because they were prioritized with that 8% pref. That was first, right? The difference is not a big deal. So in a downside scenario is really where you see the preferred return structure shine. So I know we're going long and there's a lot of still questions. Apparently it's a good topic. So I'm going to try to really quickly show you this example because I think this is powerful. So I'm going to model a downside scenario. The way I'm going to do that is by easily expanding the cap rate on sale, as all of us love to worry about. So now you can see, I mean, this is a good downside scenario, right? Now you're talking about single digit returns for investors. It's not very exciting. So you can see it's a 9.7. Oh, I'm sorry. I need to add back the asset management fee. Here we go. Okay, so it's even worse. It's a 9.2% IRR in a downside scenario. Now, let's see how the 70-30 straight split does in the downside scenario, right? You can see the cash flows are still the same in the downside scenario because all we did was change the projected sale price. We didn't change operations or cash flows. But let's go to the 70-30 split. Okay, so just to remember, 9.2, 6.3. So 0, and we're going to go to the waterfall, make it a preferred return-based waterfall. It's not working. I'm not sure why it's not working. There we go. 0, 30, 30, 30. 7.4. So you can see 9.2 versus 7.4, and the cash flows 4.9. Again, they're the same. So you can see in the downside scenario, you underperform even more because you don't have that preferred return holding you up. Okay, let's see if we can race through this other stuff. Okay. Okay, awesome. I'm glad to see that more people had the same question about the 70-30. So I'm glad I was able to answer it. Hopefully I did answer it. And yeah, let's see here. Is the refi proceeds added to cash flow for that year? Yes, it is. Yes, it is. So going back to, I know we've been racing all over the place with all these different structures and scenarios, but if we just kind of rewind and go back to what we were talking about from the beginning, this typical model, again, we said that there is no distinction of cash flow, right? When we're talking about the cash flow for the waterfall, it doesn't matter whether it's coming from a refi or cash flow or a sale, right? It's all treated the same. So a refi, for example, like in year 2, it would just get added on to the distribution here. And again, I guess I just love to show examples. Let's show an example. Let's say we have a refi at the end of year. Well, no. Let's do 24 months, and then let's do a 5-year hold. So you can see we would have, well, we have a problem here because the numbers aren't making sense. But if assuming that your refi proceeds were positive, you would have a positive here. I have to figure out why there's a bug there. But that would be the case. It would just add on to your year 2 distributions. Can you model a 70-30 split with a 6% pref? I mean, yes, of course I can. It depends what kind we want to do, right? If we want to do a IRR based hurdle, preferred return based hurdle, whatnot. But this would be what the deal looks like. I can go back to the base case scenario, 17.3%. So it actually performs well, right? Because the deal does better than the 6% pref. And then there's a straight 70-30 split with no 50-50 over 15, right? So the returns are actually better, even though this pref is lower. Okay, well, we just made it to 3 o'clock. I'm happy to stick around. Let me check my calendar. Yep, I have time. So if we want to stick around and go through more questions or open it, or if anyone has an idea for kind of a tangential topic, I'm open. Otherwise, we can wrap it up. I appreciate for everyone sticking around all this time. A lot of people on today, so I really appreciate it. And yeah, looking forward to seeing everyone on the next one.